G'day, welcome to the Australian Property Podcast. I'm Pete Wargent from Wargent Property Buyers. I'm here with Chris Bates from the Alcove Group. Chris, how's your week been?
Oh, it's been good, mate. I think I've recovered from the weekend, even though it's Thursday now. 4 birthday parties, I think it was, on the weekend. 4-year-old/5-year-old birthday parties. So I don't know if last weekend was that busy for you, Pete.
It was a bit. I think we had a kind of a festival of sport in Brisbane last week. There was the Women's State of Origin, and then there was the Magic Round NRL. So it was kind of like an endless stream of rugby league, and then we went to the Lions game. A bit like yourself, on weekends are more tiring than during the week sometimes, and you go back to work on Monday more tired than when you although actually not Monday, because we've had yet another long weekend. So yeah, pretty hectic here as well. And I'm just out on the Gold Coast this way. The kids have got some friends down here, so yeah, still working, but just trying to juggle a few things with the kids and the movie world and dream world and all of the parks and all of that stuff that goes on at the Goldie. So yeah, so pretty hectic here as well. What else is news from a work front? Have you guys got noticeably any busier since the election, or is it same?
I'd probably say it's same. I mean, a lot of people are talking it up. I mean, AFR did a stupid article just saying that this week around, inquiry was up, all these stupid percentages since, on Tuesday they released this article. I think there's a bit of a nonsense in that reporting, percentage of inquiries up 15% based on one day. I think it's
2 days.
yeah, it was a bit of a laughable story, but AFR usually does produce some great content. But yeah, I mean, I would say I do think that there's more confidence is going to be after the election. And obviously we snuck that in on the weekend and put a vote in. But I mean, what a landslide it was. I mean, that's going to be one of our big stories we're going to talk about today. How does that impact the market? I do think people are going to want to see multiple cuts. I feel people have always just jumped at shadows over the last couple of years, and they didn't think rates would go up as high as they did, so they got proved wrong there. Then they thought rate cuts were coming, and they didn't come. And and so I think people are just like, actually, I'm not trying to forecast anything anymore. I just want to see actual things happen, and I think this next rate cut's going to be one of the things they're waiting for.
I think so. You do often, or from time to time, get these articles, and the theme is basically, the phone's ringing off the hook, but there's no, you can't really get any statistical backup of an election result. I think it was interesting. We were just chatting before we started recording, and CoreLogic or Cotality put out their monthly chart pack, and there's some interesting stuff in there, like the listing numbers have dropped off, but what they identified is that the strongest demand has been on the outer fringes of the capital cities, which I think speaks to that constrained borrowing capacity that you touched on. I think when you've got people borrowing at much higher mortgage rates than they were 2 years ago or so, or maybe 2.5 years ago, it's kind of compressed the borrowing capacity is right down. It's pushed people into that bottom part. I think the more affluent areas probably need some confidence to really get flying again. It seems that has started to happen in Sydney, according to the stats, but possibly around other parts of the country, people are struggling a bit with the borrowing capacity. And as you said, they probably want to see interest rates come down further before they really pick up any kind of head of steam.
Yeah, it's almost like a reverse ripple effect going on. It's instead of buyers getting forced out because prices are getting too expensive in the middle ring, they've been forced out to the fringes because borrowing capacity has gone there. So they might prefer to buy a bit closer to the city or spend a bit more money, but they just can't get their hands on the cash, whether they're looking to get intergenerational wealth or just getting money from the bank or, what they've saved up. So also think that's just for first-time buyers or upgraders are struggling with that. It's also the investors, and they're going, well, I'd rather spend a little bit less and I can only borrow, X amount because rates are high and I can't afford a big negative cash flow. And so, so you're getting this sort of competition in the fringes. But I mean, one little thing on that pack, which we always recommend anyone listening, if you're interested in the property market, to look at the monthly housing chart pack from Cotality, is the Sydney market. The top end is for the last 3 months is actually growing faster than the middle and the bottom end, which is not what we've really seen over the last couple of years. And so maybe that's also a sign that the recovery is happening. But we sort of not that we like to forecast on here, but you could easily see that April was a strange month. If you're an agent, would you list it pre-school holidays or do a post, or You got Easter, you got Anzac Day, you got election, and you've seen listing numbers really crash over April in terms of new listings come on the market. And when confidence returns, you really want to, if confidence returns on a lot of listings on the market, then, markets won't run. But if confidence returns on a smaller or a tight amount of properties on the market, you can easily see too much competition competing over scarce resources, which is kind of what happened back in 2019 post that election. So, it's going to be interesting to see what comes on this month. I mean, it is already getting a little bit chilly. I've had to shut the doors here, and I was going to put a jumper on. So I think, a lot of properties don't sell well in winter, and a lot of agents don't want to sell those type of properties in winter. But maybe post-election and post maybe a rate cut in a couple of weeks, maybe it'll be a busier winter this year, Pete. What do you think about that?
Yeah, so one of our three news stories this week, numbers, I think, but I think just more broadly, there's just a general shortage of housing. We feel it particularly acutely in Southeast Queensland because there's so many people moving here internally, and you can just see that the construction is not keeping pace. So there's just like this chronic, ongoing shortage of housing. I saw Shane Oliver from AMP has put out a couple of charts in recent weeks. One of them showed the cumulative undersupply of dwellings. And of course, it's a bit nebulous because, it's a hard number to measure because household formation is always changing, but at least 200,000 shortage to 300,000. The other thing that he sort of identified with the chart over the past week is that the average building completion time has blown out enormously over the past dozen years. So it's taking now for a house, it's kind of taking a year to get built, whereas once it might have been maybe 9 months. Townhouses used to take maybe a year, and now they're taking 15, 18 months. But apartment projects, which in 2013 might have just taken maybe sort of maybe 21 months or so, 7 quarters or something to get built. It's nearly 3 years now. So you can just, we just have this cumulative undersupply. And obviously we'll talk about the election shortly, but this is going to be one of the big challenges for the government over the next 3 years. Building approvals figures were out this week and fell another 8.8% in April. Really slow. I mean, I guess if I was being optimistic, you would say maybe we're at the bottom of the cycle now for building approvals, but it's just taking so long to get stuff built. And so all of those things are just, sort of it's kind of a build up of pressure in the market. And as you said, very few people have listed. We've had Easter weekend, Anzac Day weekend, the election where nobody was listing or taking properties to auction. So April's kind of been a wipeout for listings. And maybe things, start to get a bit busier. That was the theme of the AFR article. Quoted InvestorKit, said about a 15% uptick in inquiry. Kate Bakos in Melbourne reported something similar. But there's a lot of people fighting over not very much stock. So that's, I think that's going to be the theme between now and the spring selling season, is trying to find good properties is really hard because listing numbers are so low and we're just not building enough, in short. So, it's kind of a bit like a rubber band being extended, sort of like a coiled spring. There's just a lot of demand, but just not enough housing.
Yeah, it's interesting. The time to complete, I wouldn't say I'm a development expert, but one of my big clients is a massive construction company, and you've got to think about it from a developer's point of view or a builder's point of view. The longer something takes, the more exposure you've got to uncertainty, whether it's material, labor, economy, interest rates, etc. And so you really want to get in and get out. You want to get things, and the more confidence you've got, how fast you can turn it around means more certainty you've got that you're going to. The project's going to stack up, and the longer it's going to take is the more you got to put a bit more variance in the feasibility. If things turn a lot more than you expect, both positive and negative, and I think that's a real problem for developers because they're like, well, and plus their money's tied up. If you can get money in and out, and you can trade it a development every 2 years versus every 3 years. Obviously, over the next 12 years, if you could do 4 lots of apartments, or you could do 6 lots of apartments, if, for example, a developer was building every 2 years or 3 years. So, it's a lot of more in and out and development you can do if you can get in and get out. So it's a major concern. I think that's why a lot of builders also and developers have been smashed over the last few years, because markets have moved dramatically over that period, and then they've used all their liquidity buffers. And so that is a great chart. I mean, what's your take on the election, Pete? We talked about it last week that, I mean, it was $1.08 and the money was right this time, which that's good to know that the markets actually got it right. But and they got it right in a big way. I mean, obviously the Labor have been a massive win. What do you think? And what do you think the impact is on the market?
It was pretty interesting in the lead up to the election. There's a brilliant blog called Mark de Graaf, a political scientist, some amazing stats. And there was a kind of a bit of concern, a bit like in 2019, that some of the polling might have been herding. All of the pollsters were kind of pointing to the same result. I think that may well have been the case, but the herding actually, the last time it was, they were sort of underestimating the coalition's chances. Well, this time, Labour actually did much better than the polls predicted. This is our first news story of the week. So on our 2 cents episodes, we just go through the big 3 news stories, and at the end we'll do some of your listener Q&A as well, so stick around for that. I think the main thing here is it was such a for the ALP that it's effectively an election mandate, so that gives us a bit of certainty and continuity. I think in the lead up to the election there was definitely a sense that we could end up with a minority government. Usually in Australia, governments don't get turfed out after 3 years, but often they find in their second term they've lost a bit of popularity, and then you end up in a minority government. And that could have been the worst case scenario, I think, where we spend 2 or 3 weeks dragging on, everyone's sort of jostling for positions, and Labour's having to make deals with the Greens and the Teals. Well, none of ALP's majority was so convincing. They've completely nullified the influence of the Green Party and some of their more sort of outlying economic ideas, shall we say. So I guess, like, just to run through the policies that will impact the economy, small business, housing. Firstly, we'll get more energy bill relief, so that will help to bring down headline inflation, $150 for all households and small businesses. We'll get an instant $1,000 tax deduction, which was a policy just introduced to cancel out what the coalition had proposed. 20% off help debt for students, so that's good if you're a graduate. I think the two, firstly, they're doubling the rate of taxation in superannuation for balances over 3 million. And also there's a proposal to tax unrealised gains in superannuation. Now, this is only a proposed policy. It's not through yet. It would have to get through the Senate, but it's causing a lot of agitation for wealthier people as they get closer to 60. And in the housing market, 5% deposit scheme for first home buyers from January 2026. I think this is the big one, Chris, for housing, because I was reading the PropTrack release this week, and it showed how since 2000, rents have increased by 48%, whereas incomes have only increased by 19%. So I imagine every first home buyer who can scrape together a 5% deposit, or who can shake the tin to the bank of mum and dad, is going to be piling to get a first home in January 2026. The thing that worries me a little bit is when you announce these policies sort of 7 months before they come into place, is that every investor in the market is going to be saying, right, let's go and arbitrage that opportunity away and buy in the first home buyer markets. But I think of all the policies that are going to come in, I think that's the big one for housing.
Look, Pete, I think there's, we're not very political on this podcast. We're not trying to say this party versus that party. I mean, the Labor have won the election. They've won very strongly. Getting policies through seems like it's not going to be a problem. I think the 5% deposit scheme, and Liberal had some very pro first home buyer schemes as well. Accessing super, I mean, that's a huge call. Tax deductible mortgages on new property, that's a huge call. So, you can't say one's better than another. But the 5% deposit scheme, which I think we should talk about, but I also just think it's their mentality around taxing wealth. There's a real crackdown on trusts. There's a real crackdown on large balances in superannuation. And I'm not here to argue whether that's good policy or not. I think that the policy is going to go through because they've won so strongly. And if you were someone who had a large balance in superannuation, particularly because it's taxed on unrealised gains, it's really messy. It's a lot of work. And, if you've got to sell stuff to pay for the tax, and, I think it's just a trend that we're heading in, right? So super's not going to be this big safe haven or this tax-free island that we were all promised. I think that the amount you can have tax-free in super is going to be really limited. And they've been doing that for a few years. But not only did they put a cap on how much is tax-free, now they're putting a cap on how much can you get at a lower tax rate as well. And they're basically saying, we want you to take money out of super. That's what they're encouraging people to do. Now, if you are taking money out of super, what do? You might pay off your mortgage, but a lot of people with big amounts in super haven't got a mortgage. You might pay off your investment properties. They probably haven't got debts on those either. They might buy some shares in their personal name, but then they go, well, I've got to pay a lot of tax on that. Why don't I just pass this down to the kids? And this is where I think that this money will go. I think it will go directly from superannuation, either to pay off their kids' mortgages, which then allow them to go and buy investment properties, or it goes down to their grandkids and allow them to enter in the market or help their first children into the market. I think all it's going to do is speed up intergenerational wealth and trying to put money back into the property market. So that's my first instance. And also the tax on trusts. There's obviously a massive crackdown happening there as well, which I think is also funneling money back to the property market. Before you're on the 5%, Pete, how does that sound to you? Does that align with your thinking?
I think so. I think tax reform is definitely going to be on the table. It's interesting because Jim Chalmers was questioned quite heavily on this before the election, particularly on negative gearing. But I mean, his take on it, which I think I agree with, is that to be reforming negative gearing when you've already got a rental crisis, a cumulative undersupply heading towards 300,000 dwellings. The last thing the market needs right now is discouragement for investors, because it's investors that actually amplify the construction cycle these days. We may see reform to something like capital gains tax. I don't know. I think Labour is definitely keener on the build to rent sector, so they'll be definitely trying to push that along. But yeah, I think you're right. There's a slightly different ideology on that side of politics as it relates to wealth accumulation. I think the thing for the next 3 years, and the massive majority, it might be 6 years. I think it's just that theme of big. I think it's going to be big Australia, big population growth. I've noticed the Indian migration agents were celebrating the big win the weekend, because they're saying there's a very strong link between Australia's Prime Minister and PM Narendra Modi in India. So I think we'll see some interesting agreements there, which will promote Indian students, Indian skilled migration, and so on. But also big spending, big infrastructure, and the big housing build. All of those things. It's just going to probably 6 years leading up to the Brisbane Olympics. So yeah, I think there will be some tax reform, but I don't think. I think in 2019, a lot of the sort of housing market community and developers were concerned about reforms to negative gearing, CGT. Look, it might take a different form this time. Super is such a massive target that obviously that's the first place they're looking, but there could be more to come as well.
Yeah, and I mean, the 5% deposit scheme is huge. I mean, a lot of clients have come to us over the last few years, and this is just across the whole country. I think there's 20,000 mortgage brokers right now, and a lot of them are 75% of loans go through brokers, right? And a lot of the 90% of first home buyers go to mortgage brokers. And so there's more than enough people for people just to have those conversations, do some numbers, and get educated on what they can do around buying. And as this policy gets more and more media behind it, a lot of first home buyers are going to get enticed by it, right? Because it sounds great, a 5% deposit. And actually, you know what? I'm eligible because my income's not stopping me. And I also think we could see some stamp duty reform as well, where first home buyers don't have to pay stamp duty. There already are different policies all around the country, but who's to say they won't tinker with those to align with the 5% deposit scheme to really create basically only first home buyers need a 5% deposit to enter the market. And, a lot of parents and a lot of people can sort of scrape that together with a little bit of savings. And I agree with you, Pete. That's not happening until January, which some people are eligible today and they'll still be eligible next year, but you'll also be competing with a lot of other people in the market next year as well. And that's also not just at the higher price points, because a lot of first home buyers aren't eligible right now because they don't qualify for the income. They've got too high income, but they might still want to buy at the same purchase price as someone on a lower income today because they're saving. So if you are in a position where you can buy today, and you don't have to wait, you've got to really question whether it's a good idea to get in before other buyers enter the market next year, and really educate yourself on what's a good asset.
I think that was one of our listener Q&A questions, something very similar to that towards the end. So we'll come back to that specific point. You're right. So the current property price limits, well, they're being raised from January 2026. So for New South Wales to 1.5 million, for Victoria to 1 million, Queensland it's I think 1 million as well. So I mean that captures percentage wise, I mean, that's the overwhelming bulk of first home buyers. So, and I think the rental market is is being crush loaded. There's just not enough rental supply, particularly at the lower end. So I think there's going to be a rush. Whether it starts before January, we'll have to wait and see. Let's take a look at this second news story of the week. Now, I have to give some kudos to Mr. Chris Bates on this, because he spent the last few months telling me that there'll be some financial innovation in the mortgage space coming in 2025, and lo and behold, this week an email landed in the inbox. 10-year interest only loans announced by AMP, together with a little media release and video. So what's this new loan product from AMP? 10-year interest only loans. Looks like they're quoting in the current market about 6.29% if you qualify for that amount. I don't know if this is unique in Australia. I can't remember if Westpac were doing something similar previously, but maybe not advertising it so much. I guess, like, just to zoom out from the specifics, I assume this kind of product would be very useful for portfolio investors, more mature investors. I don't think it will be very suitable for first home buyers. I mean, it does apply to owner occupiers, but I think most home buyers are looking to pay down their mortgage, not just have you don't touch for 10 years on the principal. So there's no midterm reassessment on this product. I think it's not exactly unique. In Europe, we have very long interest only loan periods. Santander recently introduced a 40-year interest only product over in Europe, but it's not something we've been used to really in Australia, where normally you have a sort of a 5-year interest only period, and then the loan resets the principal at that point. So Chris, is that something you've seen in Australia before, or is this something new?
But when I started backing broking in 2013, 14, I was working with mortgage brokers just prior to that. And I remember just being shocked that, you could go into St. George, Westpac, and lots of other banks, ANZ, have still got a 10-year policy, and CBA has different policies as well. And you could get 10, 15 years only, 10, 15 years interest only on your home. It'd be the same interest rate as if you're principal and interest. Even if you went to 5 years, you could easily roll over an interest only. This is responsible lending conditions just allow you to roll them over. And so while we might not be, I guess been using that in the last 5 years, particularly from the APRA crackdown in the late investment boom, I think that it's going to go back this way. The I think younger generation are more comfortable with debt. And why do you need to pay your property off if you're going to sell it one day? That's often what I think a lot of people are going to have to. I think that's just the next evolution of the property market, is that people are going to have debt, and it's going to be on interest only, and we're going to have to hold that debt all the way through our working lives. And it's the only way that you're going to be able to enter is also to hold this debt. And yes, it means you're going to have to transact in the future and maybe downsize. You're not going to be able to live in that home, but I think it's the choice of getting in or not. And I know that's not what people are going to want to hear, right? You'd love to be able to buy a house that's affordable with a debt that's really manageable, and you can smash it down in 5 years and live debt free, etc. I just think that that's just not realistic with where the market's heading. And bank innovation like this from AMP will keep coming out over the next few years. 40-year loans have been flirted with multiple times from multiple lenders. Interest only terms are going to start coming back, and easier to get them, not just on investment properties, but also on homes. And, I think only about 20% of loans are going through as interest only right now. If you look across the whole books of banks, they're very small proportion of loans are interest only compared to what they were like back in 2013, 2014. If you type in AFG index and type in 2014 or something, or even, and you'll be able to see just, how much of our loans were getting written in interest only back in the day. So, it's just I don't think it's a new policy. I mean, I think it's just a bank trying to find a little product niche that they can sell through brokers. There's always things hitting our inbox where banks are trying to add a little bit extra money into the market. I mean, I've seen some crazy policies around self-managed super funds in recent months where you can borrow a lot more I've seen some investor policies on, very low deposit investment loans of 2% that, that are coming in the market. And so there's always a risk on or risk off approach from the banks. And at the moment, it's a risk on because borrowing capacity is so tight and banks don't see it a risk to lend money on residential property.
It's a pendulum, isn't it? I think I'll just throw in some stats here, Chris, because this is something I track every quarter. If you went back to December 2016, March 2017, around that time, we had about just over $500 billion on interest-only mortgages at a time when we didn't even have $1.5 trillion of mortgage debt. So it was 39% of loans by value were on interest. And there wasn't just investors, that was owner occupiers as well at the time. But then, of course, APRA introduced a crackdown and we had an interest only differential. So if you wanted to pay interest only, you were quite often having to pay 1% extra on your mortgage rate. So everyone was like, well, if that's the case, I'll just go to principal and interest. If you look at the balances today, we've got about $250 billion on interest only. So it's only about half the amount. But the total stock of mortgage debt now is $2.25 trillion. So it's less than 11% of loans by value. So 9% to under 11 in the space of 8 or 9 years. But that having been said, there was just a change. Maybe just 2023, I think we just saw the bottom of the market. And now we're starting to see more loans. It's about 21%, I guess, going through on interest only. So it's like nothing like what it was back in the day when Westpac had virtually half of their loan book was on interest only. But I think the pendulum is now swinging back towards interest only lending after that enormous clampdown that we saw in 2017. And look, I think it's not for everyone, but for people like me, some mortgage debt and my income is up and down because I'm in business. Just went through a refinance over the past 6 weeks. The amount of paperwork involved is just soul destroying. And I think for a lot of people, if they've got the opportunity to extend out for 10 years on reasonable terms, less paperwork, and it's just less of a burden, particularly for people who've got non-traditional income streams. I think it will be popular, but not for everybody.
Yeah, absolutely. I think they're not going to be. I do think it's a mindset shift to everyone taking interest only out on home loans, but I do think it's also one of those things when the market's booming and it's their only way to get in, they'll absolutely. And I do think we need to see the banks relax lending for interest only again. And maybe that's something APRA keeps tight on its leash. They still really make it a cost on their funding. It's really reduces borrowing capacity if you go interest only. But I wouldn't be surprised if we go back to a 2013, 2014 world and in a boom if a boom in the market happens. To crack on with story number 3, Pete, around listings, because SQM have got some good data here.
Yeah, so SQM, third story of the week. It was a very disrupted month in April. Total listings fell 7% in Sydney, 7% in Canberra. They actually were down in all 8 capital cities. I think from a year ago, some markets like Perth have higher listings. So I suppose you could say that's the sign of a market which is reaching a peak or crescendoing a little bit. Also, Cotality do some figures. New listings numbers were down 16.4% in April. So, yeah, look, I guess the theme here is that, it was a very disrupted month in April. Maybe there's a bit more certainty now the election's out of the way and we've got we're going back to some 5-day working weeks. But, yeah, I guess it just feeds into that general thinking. Prices increased 0.7% in April, driven by a large gain in Sydney, and also Darwin that we mentioned last month is having something of a mini boom driven by some investors from interstate. But I think this could be a theme potentially, Chris, over the next few months. Is there's just not that much stock listed, and a bit of a supply demand imbalance because we've just got rapid ongoing population growth and maybe just a little bit more confidence feeding through now the election's out of the way.
Yeah, it's always the age-old problem, right? When markets are tight, no one wants to sell. Everyone sits on their hands. It's like a Mexican standoff. And whereas prices start running, people are like, oh, maybe I do need to upgrade because I might not be able to do it if I don't do it now. And then they list their property or they buy before then they list their property after. And so the market, listings, I feel like they come in waves and they have to get momentum behind it. But it's usually when prices are going up. I mean, a lot of people can't afford to move until they get a certain price. They need to have a certain amount of equity left over or cash to allow them to move to another property, or even investors don't want to sell until they get hit a certain number. There's an anchoring bias or something they're aiming for. And so, markets, it's just in downturns or, often when there's uncertainty, everyone just sits on their hands. And it's been an age, a real problem over the last 5 years. If you have a look at where we are today versus the 5-year average, listings are way down on the average. But if you went on the 10-year average, it'd be even way lower. Because every year the turnover rate and how long people are holding property is increasing. And so, I think it's one of these, agents talk it up all the time. I love seeing agents, and there's a time this week as well where, more listings are coming, everyone's going to sell. And I just don't think the macro force and the trend is tighter listings year on year. And every year we get disappointed where, total listings is really tight on a situation where the owner occupier rate is reducing, got more migration, etc. And so demand, you'd have to say, is building. There's pent up demand building, and supply is on a slow trajectory downwards. And we can't really build enough either, because of all the reasons we've discussed many times on this podcast.
Yeah, I think the cost of construction, it's interesting, isn't it? Because you would say, well, if rents have gone up 48% and prices have done something similar, well, normally you get a big supply response. But actually, the cost of construction has done very similar, I suppose, over the past 5 years. And developers are struggling with margins. A lot of them were building on fixed price contracts and went insolvent. Interest rates haven't helped either. So there's a lot of things that have just gummed up the housing supply. I think being a bit more optimistic, I think we'll start to see things picking up over the next year for building construction times and for delivering stock. But it's I think even just year to date, financial year to date, we've approved 135,000 dwellings. Well, the government's target was 20,000 a month, which would be 180,000. So we're already in the first 9 months of their 1.2 million target. So it's we've got some catching up to do, that's for sure, and it's going to be a long slog, I think, over the next few years. Let's go through a few listener questions before we wrap up. So do send in your questions. You can find the link in the notes. Always keen to answer whatever people are interested in talking about at the moment. So here's the first one from JJ. I'm an investor. I'm just starting out. Should I buy a trust to buy a rental property or buy in my own name? Look, I suppose this is, I suppose at first I should say a question for your accountant, but in general terms, look, statistically, most people invest in property in their own name. I guess there's less admin and less cost involved. I suppose if you set up a trust, then you're going to get into the realms of setting up costs and annual accounting and audit fees. You might also pick up more land. And if you've got a negatively geared property, you might be saving tax at a lower marginal rate than you might be in your own name, depending on what tax rate you pay. I think, though, the main benefit of a trust, Chris, is for a lot of people the asset protection. So I think if people are building large portfolios, become more popular, or if you work in an occupation like if you're let's say a brain surgeon or something like that, where there's a higher risk than normal of being sued, then I suppose that's when people lean towards structures for asset protection. But do you get that people are sort of asking that question to you guys when they come to you for a mortgage? And if so, what do you say?
Look, I do think it's tax advice, right? And while we were licensed financial advisors and tax financial advisors back in the day, and we have lots of strong thoughts on it, I do think it's something you want to speak to an accountant. Unfortunately, that when you speak to accountants, you've got to make sure you can trust them, because ultimately, there may be potentially some are incentivized to sell you the trust because, maybe there is asset protection benefits, but you just want to really understand what are the benefits for you and how big are they based on what your situation is. And I think the key part of this question is starting out. Often that, have you got a big portfolio? Are you in a job that's a higher risk? And obviously when people are starting out and they're building portfolios, they haven't got much cash. Like, that's just the reality. Like, it's just often you're leveraging at a higher percentage. Maybe that also means you've got a higher negative cash flow usually. Can you deduct that? How can you afford it? Trusts can't lose it, have to be, positively cash flowed. So, really understand, the cash flow implication. And also you might want to keep your cash back with an investment property. Yeah, you might have a home, so you might be starting out from an investment point of view, but do you really want to be putting any money in for an investment property. Maybe you should be gearing up against your home and borrowing not just the purchase price, but also stamp duty, and make it as negative gear as possible while you pay off your home loan, which often makes sense. And so, yeah, it's a very broad question. And like you say, Pete, there's sometimes consequences with, borrowing. There's sometimes consequences with land tax, etc. But I think people like the word trust. There's also a crackdown on trusts, which we mentioned earlier in the podcast. And a lot of the ways of splitting income, and particularly if you're in certain professions and, with larger balances, is actually much harder than it was just a few years ago. And so I think there's an attack on trust just more broadly.
True. It's not an either or answer, I guess. Just be mindful of going with your eyes wide open, and just be mindful of land tax implications. I've had people come to me over the years and they said, "Oh, well, I bought these properties, and my accountant told me to get a trust, and he didn't. And then it goes up every year, and it's like causing me headaches." It's like, well, yeah, that's it. Like, if you got multiple properties in one state, then you probably will have some land tax issues in a trust, and you just need to understand the thresholds and the implications there. Second question, we'll finish up on this one from Bluebird. I'm a first home buyer. This is almost exactly what you were talking about earlier on, Chris. Do I buy now, or do I wait for the 5% deposit scheme next year and avoid lenders' mortgage insurance? So I've got no more detail to the question than that. What do you say, Chris? So I guess you must have that sort of a question as a mortgage broker all the time. My implications. What would you say?
So if you can buy with a 5% deposit now, and you decide whether to wait now or till next year, you probably should potentially buy now if it makes sense for your broader life, and you can get a good asset, and you've got a buffer, and etc. But if you haven't got a buffer and it's really tight, and you've got a lot of uncertainty with work and things like that, then you're not sure where you're going to be, and maybe you need to get that clarity before you buy. That's just and you're not sure whether you can get a good asset. You don't know what a good asset is. Then it's not always just buy. But if you're in this position where you can't get access to the 5% deposit scheme right now because your income's too high, but you could in January, but you've also got enough cash to buy today, but you'd have to pay lender's mortgage insurance. It really depends on how much cash you've got, because if you've only got enough money for a 5% deposit plus stamp duty, lender's mortgage insurance is really expensive. There are some sort of low deposit home loans to consider as well. There's more and more of these coming in the market. Something called Sukasa is one, which is an alternative to paying LMI, really. But if you could get yourself to like a 10% deposit plus stamp duty, so maybe around a 15% you need, and it means you pay 2% LMI. Let's just call it 2 states, 2%. It might be a little bit under that if you can get under 90%. Then you have to think, if markets move 2% over the next sort of 6 months, which is like the spring selling period, and then it might take you a while to buy next year. Yes, you can buy from January. It doesn't mean you can buy property in January 1st. It might take you February or March till you find something. You might miss out on one. And so you could be buying maybe, 6, maybe even 2 cycles. You might be buying late in the autumn, and you've got a spring selling period. So if the market moves 2%, you might regret not paying that LMI. And I think that's sort of the conundrum I think a lot of people are at right now. So whereas, it goes, I can get a 95% loan. I've got more cash as a buffer. I didn't pay LMI, but what's it matter if you ended up paying an extra 7%?
You capitalize the LMI into the loan.
Yeah, absolutely. Exactly. And we don't really like doing LMI once you're borrowing more than 90%, like, so 92% or 93%, the LMI goes 3 or 4%. But even in that situation, maybe you'd be better off consider that if there's a real strong demand going to come early next year, particularly if borrowing capacities go up and interest rate cuts happen as predicted. So, it's one of those moments where sometimes you can try to avoid paying fees, but you might end up paying a lot more in a purchase price, which is just higher than what those fees would have been.
I think the key message, as you said there, is to try buying a first home is one of the most emotionally taxing things you can do. It's one of those sort of landmark steps in your life journey. But even though it's an emotive subject, I think to know as you can about it is really good advice. I think the older I get, the more I try to take rational financial decisions. I think a lot of things can be emotively driven in the housing market. So I saw the big fella Warren Buffett stepping down age 95 this week, and handing over Berkshire Hathaway, Greg Abel. But that's a good visual image for yourself. One of the most rational thinkers about money over all of these decades, and it'll be sad to see him go. So, yeah, I think run the numbers, try to be as emotionally detached as you can. I know it's very difficult when it comes to a first home. So, what's on for you this weekend, Chris?
Not too much, to be honest. I think it's Mother's Day on Sunday, and can take a little boat out on the Hawkesbury. Not too much else, Pete. What about yourself?
Well, with the kids, I've got some friends here on the Gold Coast, so I imagine I'll be dragged along. I haven't been over there for a few years, but we've been sucked into buying these annual park passes. So I've got to get my money's worth. I think they're $800 for a family for the year. So the kids will be going to SeaWorld a lot over the next 12 months, I imagine. got to get your money's worth. So it's beautiful weather here, actually, the Goldie. So always fun. The kids love surfers and Cavill Avenue and all of that stuff.
Absolutely, Pete. Well, thanks for listening, everybody. Happy Sunday. Happy Mother's Day to everyone listening, and look forward to the chat next week.
Cheers. Thanks, Chris.
Thanks, Pete.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.